Hello everybody, this is Jose. We are about to start here, and as you can see on the upper left side of the screen, we have the chat room key. Please make sure you are in the right room using the right key number, and make sure you type a quick hello as I am doing myself, so we can confirm that the chat is working as the session is about to start, so we are ready to begin. In the meantime, I will turn on the disclaimer in the bottom part of the screen. I'll give you guys 30 more seconds to go, and then we begin. Okay, everyone, just waiting for the hellos. So I know everybody's connected and we are ready to begin. Please just type a quick message inside the chat room using the room key number above so we can begin. Thank you so much. I am about to start sharing screen in just a second. While you are connecting with the chat room, while you are reading the disclaimer on the bottom part of the screen, which I will remove in a moment. So you have time to read it as well. Wonderful. Thank you, Joe and Jeff. This is great. It's great to see that we are connected and ready to go. Wonderful. Perfect. Okay. So let's begin. Let me go ahead and show myself. Hello, everybody. I'm here in the bottom right side of the screen as always. Welcome to our session. We are hosting our trading and review sessions once per month. This is my Thursday. So happy to have you. Happy to be here as always. It's always a pleasure. And today, to be honest, we have a little bit of a special session because normally in these sessions, the format would be that I say hello to everyone, I ask you how are you doing, and I ask you how I can help you. And in that sense, maybe we talk about, building an option spread or talking about trade management or whatever it is that I can help you with. The name of the session is called Trading and Review, so that says it all. But today, you actually already told me last Monday what is it that you need because we had an open meeting. And in that open meeting, we talked about backtesting, we talked about Monte Carlo simulation, and therefore this is going to be the topic for today. Today, even though we have charts on the screen right now, to be honest, we are going to spend the session on a spreadsheet, looking at backtesting, looking at Monte Carlo simulation, and we will talk about this concept, which is it will be a very powerful and very healthy conversation to have. So I'm excited about today's session. In any case, I may be able to make a little bit of extra time. So if you have additional questions or anything like that, feel free to type on the chat box. But again, the plan, unless there is anything else, it's Monte Carlo simulation today. Okay, so we'll talk about what it is, how to use it, how can we implement it. And by the way, I'm going to be building a spreadsheet. Actually, to save time, I already prepare it. And obviously, I'll be happy to share that spreadsheet with you guys once the session is over, so you can use it for your own activities. So that's the plan. Wonderful. So good. I see you there. So Joe, Jeff, everyone. So if you just joined, notice on the upper left side of the screen we have the room key. Make sure you get into the room key if you don't know where to go and you're new to our sessions. So you can see here on the bottom part of the screen the website speakup.info. That's where you want to go. And then inside that website, you enter the room key, or you can also download the Android or the iOS app, and then you join the chat this way. Joanne, this is great to see you. Yeah, today we're going to spend some time on a spreadsheet, Joanne. Can you believe that? Very good. So, hey, here's the spreadsheet. Okay. Lots of data, lots of figures. And by the way, Jeff, a special thank you to you because you are the extra motivator for us to talk about Monte Carlo simulation today. And as you may recognize, the data on the spreadsheet here on the left side is actually your data. So we'll be talking about that a little more later. But again, thank you, Jeff, for putting us all in this position today where we are talking about backtesting and Monte Carlo simulation and looking at trading expectations in a way that is more powerful than simply having a list of trades, okay? And looking at things more intelligently. Okay, now, having said that, it may be a little bit of a temptation to look right and left on the spreadsheet, and it's a little bit busy. So what I'm going to do first is I'm going to zoom in all the way to here. So not only things are large on your screen, but also you don't look too much to the right now, because I will need you to focus on the left first. So that way we will be able to then evaluate what's on the right, okay, which is the Monte Carlo simulation itself. So first of all, let's look at what's on the left. Again, this information has been provided by Jeff all the way from column A to column L. We have 112 trades that have been backtested. And again, whatever those trades are is not relevant. Out of curiosity, Jeff has been backtesting trades on micro WTI crude oil, which is the contract that trades on the CME. The symbol will be MCL. And his backtesting technique has to do with a trend following system using a combination of moving averages. Again, to be honest, what we are going to discuss today is universal. So the application of what we're going to learn when it comes to doing a Monte Carlo simulation applies to everything you trade, no matter the method, including if it's, let's say, non-directional options trades. It doesn't matter what. In the end, you will have a column with results. In this case, is the column N. And you will have X amount of samples. In this case, we have 112 trades that were backtested. And as long as you have enough samples, being the minimum 30, even though it's a real minimum, so ideally you want to go for 100 or something like that. So as long as you have a minimum of trades that make this data sample to have meaning, then you can start, playing with the data. And I'm using the term playing, even though what we're doing today is quite serious. So you can start playing with the data in a way where you can extract conclusions which are more powerful than the result of the backtest. Because let's say that you have backtested, and for example, here you can see there is a moment in time with 3 winners in a row. There is a moment in time with 4 winners in a row. So what if instead of 4 winners in a row, it were like 4 losses in a row together with that one and that one? Now it's 6 losses in a row. So what, right? So in the end, at the end, you may have ended up with a totally different result than the result of these 112 trades. So the idea is to utilize a backtest set of data to then randomize it and come up with many more scenarios of things that could have happened in a different way, in a different sequence, and see if that methodology still performs well, if those moving parts are actually moving, and the world in the future is not exactly like the world during the backtest, during those dates when 112 trades were identified and logged on the spreadsheet. Okay, so this is the idea. Okay, cool. So first of all, a brief description of the columns. So we have date. So we have the trades were backtested starting in January 2023 all the way to, we got 112. So that is all the way to July 3. So as you can see, it's a pretty recent set of data. Great work, Jeff, there, because all of this is tedious. Many people may feel lazy about it, but to be honest, this is how you end up putting something together that has meaning, that you know what it is, that you have good control over it. And then, if you start trading this live, you'll be confident because you've built that, right? Where for the rest of you that are watching this is going to be a great example, but I would suggest that build your own set of data by doing your own manual logging process in this particular example. That, of course, will depend on your methodologies, but just do it yourself so it's your thing. So you know exactly what's in these columns, you understand that well, and then if the statistical results are good, then you will feel very confident at trading it, because not only the results are good, but you know exactly what you have input here. So it's very important to put the time and the effort like Jeff has done. So congratulations, my friend. Good job. So we have the date, we have the entry price, and then the direction of the trade. So notice how some of those trades were long, some of the trades were short. Those are intraday trades with micro crude oil. So that was the entry price in this case to go short. That was the entry price in this case to go long. And then there was a target and a stop. Okay, there was a target and a stop. And of course, sometimes the target was hit, and sometimes the stop loss was hit. Right. So there are cases where 2.59 points were made. That times one contract would have implied $259 of profit in this particular case. There was a case where 1.34 points were made. I mean, in this case, it's negative, but it's just because it's the difference between the way the spreadsheet has been calculated is the difference between going short or going long. So the calculation of the size of the win is either positive or negative. But really, what matters is that 1.34 points times $100 per point, which is the point value of micro crude oil. That is $134. And then some of the trades were losing trades, where, as you can see in this methodology, it looks like, and Jeff, feel free to confirm on the chat, it looks like Jeff has a very static rule here where if that market moves by 0.70 points against the trade, so he's out, and he's out for $70 of loss, which in this case, on the data that was sent to me by Jeff, the loss is identified as a positive number. Notice on the right how I changed it to negative number, and you will see why later. But it doesn't matter. It's totally correct to do it like that. And then we have the time when the trade was entered, the time when the trade was exited, which could also help with further statistics when it comes to calculating the average time that you stay in the trade and things of that sort, which could validate this is a methodology that you could actually trade, because maybe some of the trades are too short and only a computer can run it. Maybe a human is not fast enough, or the opposite. Maybe some of the trades are way too long lasting. It's not the methodology you want, and maybe you end up changing time frames. So again, the purpose of doing the backtest, which is all this work here on the left times 112 rows, all this work has to do with getting the results, getting the outcome of your methodology, so you understand the behavior of such methodology and what to expect from it, together with understanding if the methodology actually is adequate and matches your intentions as a human being executing a trade, such as, like for example, here I can see some of the trades were taken at 4 a.m. So the question is, are you awake at that time, or was that 4 a.m. in New York and therefore is 4 p.m. in Asia? So again, all of those things have to do with the convenience or the compatibility of being a human trader. Okay. Anyway, with all of that said, and let's assume that everything on the left it's adequate, and the trader has decided, those 112 samples are the trades I would have taken. So now it's time to start looking a little bit more on the right and see what we get from the right, and most importantly from the Monte Carlo simulation. Very important point, the one I just made. If they are out of those 112 rows, there were to be rows that represent trades that you would have not taken, because we are not awake 24 hours a day as a human trader. So, when doing your statistical analysis of the outcome of the trade, you better remove that, because then you would be getting statistics out of something that is not what you would trade. So you want this to be as realistic as possible. Okay, so this is something important to keep in mind. So in this session, I'm just going to use the data the way Jeff has sent it, which a normal outcome would be that after looking at the data, after reviewing the data, after processing the data, after evaluating the data, after doing a Monte Carlo simulation on top of the data to have further analysis of the outcomes, you may now end up deciding, so I'm not going to do this, I'm not going to do that, and then you end up with 60 rows instead of 112, and then you put that on a new spreadsheet and you do it again, and you rerun a new Monte Carlo simulation with the exact trades that you would have taken based on what you learned from this process that we're going to cover today. In other words, you try to make this as close to reality as possible, and I mean the reality of the human trader who is going to execute this, instead of just keeping it like as a research project for a university, which is very theoretical, very interesting, but would not represent your day-to-day life as a human trader. Okay, so it's important to keep that in mind. If you guys have any comment to what I just said, feel free to mention it. Happy to take your comments. Of course, if you have questions too, but it doesn't need to be a question. It could be comments. Some of you here have been trading for a while. Some of you for a long, long time. Some of you are new. So some of you may have questions. Some of you may want to share prior experiences, and feel free to enrich the session or ask questions anytime. Okay, I'll be checking the chat box all the time as the session develops. So moving to the right, little by little, now I'm going to stop on column N. So notice that while Jeff had winners with a positive number and losses with a positive number as well, so notice how column N, it's now using positive values for profits, negative values for losses, and also just to make it more visual, a red background color when it's a loss, a green background color when it's a profit. The reason to do that is just because it's nice visually speaking, but the reason to use negative signs when it's a loss is so I can add the column. And if I add the column and I go down all the way, so notice how I put the formula here on row 203. So even though we have 112 samples, I could have had this sum in row 113 or 114. I just went all the way to 203 just to give more space to the spreadsheet in case, you, Jeff, or, when I distribute this spreadsheet to all of you, if you guys want to add more samples beyond 100 all the way to 200, so you have space. And of course, once I send you that spreadsheet, you can move things around. You should move things around to make it yours. But anyway, so here is the sum. And of course, I could not do the sum unless I got positive signs for profits and negative signs for losses. So this is out of convenience. It doesn't need to be like that, but it's convenient to have it like that. So now, once I got all of these, and by the way, just to be visual and not to need to scroll down, here on the right, I got the P&L, the total P&L here of these 112 trades, which is $4,799. So once I got these in front of me, now I started calculating certain statistics that are related to the sample data. So these statistics are related to what you've got, Jeff, which again, what you've got is in the past. When you start reading this methodology in the future, I mean, it would be a miracle that the future is exactly like the past. Okay, so again, this is a good reference, but this is not what I care the most about. Because this, if you expect that your methodology is going to perform exactly like it did in the past, there is a little bit of hope built in that statement, because again, it's the nature of this market, the nature of the behavior of methodology should remain to a certain degree. Well, having an exact same behavior the next 112 trades, it's basically almost impossible. So we will have some variability, and therefore these values here are out of gaining some understanding of what is it that you put together and how it worked in the past. But because it's the past, I'm not that interested. Okay, but anyway, let's start looking into it, because then a good analogy, a good comparison as well would be to compare what we think the future will be with what the past has been. And this is why these values are there, to also evaluate the stability of this methodology into the future. Okay, so I see MJ. MJ, hello MJ. Your video is blocking the Monte Carlo. Yes, no worries, MJ. It's actually, I'm kind of doing it on purpose, so you don't look at that yet. So you stay with me, okay? Because I will. There are many more columns on the right, which I also need to explain before we look at the Monte Carlo results. So it's kind of convenient. I didn't do it exactly on purpose, but it's kind of convenient that my camera is actually hiding the Monte Carlo results, so you don't go there immediately, okay? So I want you to understand the rationale, because then later, if you use that spreadsheet for your own trades, I want to make sure you are confident and you know what is what and what the meanings are. So stay with me. Stay with me, please. Uh, Great comment, and thank you for that, by the way. But again, I guess you get my point and why I want you to stay with me now. Okay. So first of all, median win. The median win that the past has produced with this methodology was $90. Now, the median is not the average. Okay, and again, I'm going to simplify a little bit mm, some of the terminology that as statisticians or mathematicians, a purist person would use. I'm going to simplify it a little bit because I assume that while some of you may be, very into math, some of you may not be so much into math. So I'm trying to make myself understood here, and therefore I'm going to use a little bit of an oversimplification and say that the median, it's kind of like the average, but it's a little bit like the average of what happened the most often. Not only the average in the sense that it's in the middle, but the average in the sense that it's kind of weighted towards what tends to happen most of the times. So this is kind of like what is mostly expected. So notice how some of the results were 259, 134, 100, but 90 tends to happen many, many times. And therefore, when you look at the whole sample data, we have a formula here, which you can see, which is an Excel formula, which is median. And that is basically telling us that what tends to happen the most often is 90. So it's kind of like the midpoint, but not only the midpoint by being in the middle, but because it happens more often than not. Okay, so it's what we're expecting. Thank you, Mark. So so this is important to know. So this methodology produces that, and as a loss, the median loss is 70, which means that this is not the worst case loss. There are some cases which, by the way, may be typos, but there are some cases where we got $73 of loss instead of 70. So I don't know if this was slippage or that was a typo. I'm not sure. Okay. By the way, typos could happen as well. It's when we run stats on data, we better make sure the data is impeccable, because if not, then the results will be not aligned with reality, because the data was not aligned with reality, right? So we need to make sure that that's impeccable. But in any case, of course, we can also get slippage in our trades and things like that. So maybe that was the case. So again, the meaning of median loss doesn't mean the worst case loss or the average loss. It means that the type of loss we get most of the times. Okay, so that's what's expected. So what's expected from a profit point of view is 90. What's expected from a loss point of view in this data sample is 70. Now, the standard deviation of the wins means how much above and below 90 we fluctuate in a one standard deviation of the cases, meaning in 68+% of the cases, the profits may be a little above 90 by $23, maybe a little below 90 by $23, and the losses may be a little above 70 or a little below 70 by $11 in 68% of the cases. So you want a methodology that produces numbers like these, which are as small as possible. Because if those numbers are as small as possible, it means that the variability of the methodology is not too much, and therefore the stability of the methodology is more. So, of course, in a perfect world, the median win is very large, the median loss is very small, and those numbers would be zero. That way, it means that you always get that. You always got that type of a win, you always get that type of a loss, and it's always like that because standard deviation is zero. That would be amazing. But again, there is variability because things are moving. So again, you want to keep those values as small as possible. So again, this is data that will help you to evaluate if your methodology, it's stable or not, and what is it that it produced. But again, in the past, and the result of that in dollar value was 4,799. So again, if you were running these with one contract per trade, you would have made that in 6 to 7 months. All the way from January 3 to July 3, which is 6 months. Okay, so what else? Win-loss ratio. So we are talking about 68.8% of the trades made a profit. Now, this is without including commissions. This is without, I assume, without including slippage cases, because this is a backtest result. So again, the reality may be not as positive, but certainly it looks like a great number. And when you look at this number combined with the reward to risk ratio, and notice that for reward to risk ratio, we are using We are not using median win and median loss. We are using average win and average loss. And notice how the average win is 154. That's the average win. Even though what tends to happen the most often is 90, the average loss is 70, and what tends to happen the most of the times is 70, which means that in this backtest, Jeff has been perfectly disciplined, taking the stop out when the stop out had to happen. There were no violations of the stops. The average loss is 70, the median loss is 70, so very nice. But then when it comes to the average win, notice that even though the average win is 154, the reality is that what tends to happen most of the time is 90. So from an expectation point of view, that 2.19 to 1 that looks good on paper, looks very good on paper, in the real world is probably a bit different. Okay, and this is now I'm touching a little bit on what we're going to do with Monte Carlo. With Monte Carlo, we're going to do many things, but one of the things is try to understand worst case scenarios and randomize the whole thing. But really, really understand worst case scenarios, because you can see here very clearly that if I was to only think of every time I profit 154, where the reality is that most of the times when you profit is 90, the difference is substantial. So if you were to expect the methodology to behave based on 154 wins, where the reality is that the medians, which is what happens most of the times, is 90, so then the difference between what you expected and what it's likely going to happen would be too large. You may approve the methodology and you may end up losing money altogether at the end. So again, Monte Carlo is going to come in as a very neat tool to understand worst case scenarios better, to understand, to randomize things, to create all sorts of different scenarios that could have happened with the same method and the same market. Okay, everyone, I'm gonna take a sip of water before I keep going. How is it going? Give me a little bit of feedback so I know that everybody is okay. A quick all is good is enough, but give me that, please. And if not, if you need me to repeat something, let me know, because this needs to be very well understood, even though it's very basic. And maybe if you are into math and spreadsheets and all of this, I am actually boring you because I'm going too slow. But at the same time, I'm taking my time here, because if this is not understood, then what's coming next, will certainly not be understood. So I want to make sure all is good. So give me some feedback when you have a moment on the chat box, okay? Everyone, don't be shy, please. Now, another very important parameter here is to understand your worst case loss, which in this case was 77. So even though what tends to happen most of the times is 70 and the average is 70, there was a worst case of 77. So again, not sure if it's a typo or it was a real case, maybe a little intraday gap, something like that. And then finally, we got a formula here just to have an initial feel of what could this methodology do for us, which is called expectancy, where we look at the reward to risk ratio, 2.19, we multiply this times the win-loss ratio, and this basically gives you 1.5, which means that in theory, with a very positive approach, which is not realistic, but just to get a feel, in theory, for every dollar you risk, after 112 trades, you are supposed to produce $1.5. That's kind of like a little bit of a summary of everything we've covered so far, but again, based on what happened in the past. Okay, that this so far doesn't say anything about the future. Okay, so now we're gonna start moving to the right. Okay, so what do we have here on the right? A bit more. Okay, so what do we have here on the right? So here on the right, we have a few more columns. Let me make this a bit smaller so all the columns fit. Okay, I think this is great. So what do we have? So first of all, we have, again, the wins and the losses that our backtest has produced. Okay, so this is the real results from the past. Okay, we have 112 of those. So if I go down, this goes down all the way to row 113. 113 plus the header, where we got, date, entry price, all that. So that's 112 trades, as we know. So these are the real results from those 112 trades. And then what we've done here now, okay, it's a different thing, which is, I won't get into this formula too much. I will just briefly kind of explain what this is doing, because you can see here that we are using a a formula where we're using a random function where we are basically using a normal distribution. Normal distribution is, again, I'm completely oversimplifying, everything that has to do with stats and probability theory, but please bear with me on that. A normal distribution basically means anything could happen anytime. Let's put it like that, just to simplify. So what I'm doing is, okay, so if anything could happen anytime, so pick a random number from 0 to 1. 0 0 to 1 is the whole possibilities within probabilities, right? If something could either not happen or happen 100%, or anywhere in between. And in the concept of normal distributions, we represent probabilities in the form of a bell curve, where the midpoint is the mean. That would be 0.5. All the cases on the left go from 0 to 0.5. All the cases on the right go from 0.5 to 1. So that random formula is helping me to produce random numbers anywhere from 0 to 1, which means cases that could be of all type of outcome. So I'm randomizing that, and by doing that, so notice that this $259 profit in a different scenario, different possibility, could have been, statistically speaking, if the market had behaved differently, it could have been $74.85 if I randomize it. This $134 profit could have been 98.27. This $70 loss could have been 59 loss. This $70 loss could have been 63. This $100 could have been 87. This $90 could have been 115. In this case, is more. This 70 could have been 69, is less. This 70 could have been 80. In this case, is more pain, more loss. So again, all of this now is randomized. And if I was to add the net result of this randomized variation of the outcome of the trade, so this one would have produced $4,427, which is less, in this case, is less than 4,799 that the real backtest had produced. Okay, and now, so I'm just gonna go ahead and force the spreadsheet to calculate another number, and now I just randomize it again. Notice now it became 4,278. If I was to randomize it again, now it's 3,759. So notice how, as I randomize, the outcome of the methodology is going to be different. It's not going to be like what happened in the past, right? Keep going. How is it going so far with this concept? Everybody with me on that? Okay, let me know there. Yeah, I can see you're okay. This is great. Keep going with those okays. If all is okay, if you have questions, let me know. The other thing I've done here is I also added another column called the drawdown. So when there is a profit and there is a profit, anytime there are profits, this column is empty. But the moment there is a loss, so that size of a loss is reflected on the drawdown column. But now, if the next trade is also a loss, those two losses together I added, and the net result, which is 159.47, is shown. So if there is one loss, is one loss. If there is one loss, is one loss. But the moment there are multiple losses in a row, those multiple losses in a row are added, producing a total value for the maximum drawdown. In this case, if we have 3 losses in a row, okay, this one and this one, and this one, so the numbers are added, etc. Okay, so this allows me to calculate what is my worst case drawdown. Okay, this allows me to calculate that, which is something which is very powerful. In my prior calculation here, I did not calculate the worst case drawdown, because, to be honest, I mean, it's interesting, but who cares? Because the future is not going to be like that. So my real interest, and that's why I'm doing the Monte Carlo simulation, is to understand. Sorry for moving my columns like that. I'm probably driving you crazy. My real interest is not only to find out how much I'm going to make, but in order to make whatever I'm going to make, which in this case is 3,759, my real interest is also understand how much pain I need to go through to get that. Okay, and this is where this comes into place. Mark, will the randomized function also give results greater than the original result? Yes, 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 because there is a standard deviation here, right? Where the results could be above by this amount or below by this amount above the mean, right? So you could have results where you lose less than you lost in the backtest, or you lose more than what you lost in the backtest, and you could have results that made more than what you made in the backtest or made less than what you made in the backtest. So anything could happen, and it's randomized. Okay. So now, if I look at these three columns, V, W, and X, so you now know that in this particular, variation of the original backtest, we produced 3,759 with a maximum drawdown of 204. If I force the spreadsheet to recalculate one more time, so now, okay, I'm not sure why it didn't do it. Okay, now, so now the result is 4,200, and in order to get that result, the maximum pain I will go through is, it was 200 something, now it's 186 in order to get 453. So you can see how this is working, right? So every time I hit certain key combination on my keyboard, I'm forcing this to recalculate. And every time you can see that there is a pattern, right? There is a pattern that has to do with the methodology and with the market you trade, which seems to be, I guess, a trending market, or has been trading during 2023 since the beginning of the year. And therefore, this methodology with moving averages is, every time I refresh, seems to be producing a profit in exchange for losses, and the losses are around $200. But again, there are so many times I could hit my keyboard and memorize in my head those values. So what I've done here on the right is that I am now producing with a bit more complex mathematical formulas here with Excel. I am now producing 1,000 iterations. 1,000 iterations. So I'm going all the way to 1,000. Here we go. And notice that all of them ended up with a different result. All of them ended up with a different drawdown amount. And now, by having this methodology replicated with some randomizing effect times 1,000 times, now I am in a good position to reveal and get into understanding the Monte Carlo results we got. So let's review this. Okay, before I do it, are all the columns on the right understood? Please give me some confirmation in the chat box. Okay, and that's for everyone. Please, everyone, type yes or no. And if it's no, let me know why would you like me to re-explain. Okay, so I'm just waiting. So while I'm waiting, so first of all, what I have here is, we got 112 trades, just something nice to see, visually speaking, because again, any number of trades that is less than 30 is completely meaningless, and even 30 is not that much. So make sure your data sample is large enough. And then now we're getting into the results of the Monte Carlo simulation. So that column with 1,000 cases produced results, and the best case scenario of all was producing $5,000. That is the best case scenario possible in this particular case. The worst case scenario was to produce 3,700, which that is significantly less than what the backtest produced, which was 4,700. That is $1,000 less. That's 25% less money than the backtest. So you can see here how useful it is to run Monte Carlo simulation when it comes to getting, a better grasp for expectation in the future, because you could be very, very disappointed if you set up some sort of a trading methodology, you expect to produce that amount, and next thing you know, you produce 25% less. So you may be like, oh my God, that was not even worth it for me to trade. So, again, I'm just phrasing possible scenarios. So it's a lot less. Now, in any case, even though it's a lot less, it's still profitable. Okay, clearly profitable. Then what else? The median. Remember, the meaning of median is what tends to happen in most of the cases. So what tends to happen in most of the cases in that collection of 1,000 variations of randomized outcomes is $4,400. I am rounding it up. Okay, 4,400. So the backtest produced 4,700. What tends to happen in most of the cases is 4,400. So it seems that it was slightly in the positive side, but pretty close to what the median would be. So it does look like the future will likely resemble 4,400. And in all those 1,000 simulations, 100% of the cases were profitable. There was no case where there were losses. Actually, the worst case scenario was 3,731. So, in other words, Jeff, you have something very good here based on what you found. Now, later, I will talk a bit more about analyzing all of this with a skeptical mindset, and I will make some points because I believe you need to do some tweaking and review to make sure that this is real because it looks very good and a little bit too good to be true. And in that sense, it makes me a little bit extra skeptical as well. So I'll talk about that later on. Okay, but what you've got is what I just represented here, based on what you input during your backtesting process, and it looks like if you take what you've got and you randomize it times 1,000 times, 100% of the cases will produce a profitable outcome, with the median being $4,397 of profit. Now, this is a very important thing because you have a profitable methodology in your hands that is very likely going to perform well in the future, or perform similar to your backtest in the future. So that's a very good thing to know, which could not have been the case. Again, remember earlier when we talked about these figures, the standard deviation, and I told you the smaller the figures, the better. I said in the perfect world, those figures are zero, which means that you always get that type of a profit, you always get that type of a loss, it does not vary. So that would make your future variations to be almost equal as the backtest in the past. So the larger those figures, it means that you got changes, and the more the changes are, when you generate randomized outcomes, and as you randomize those outcomes, you have a large standard deviation value here. So the methodology in the future would certainly extremely likely behave very different compared to what you had in the backtest, and you could have ended up here with minimum cases with negative values, where after 112 trades you lose, and therefore you will not have 100% of the cases to be profitable. Maybe you have 80% of the cases profitable, and therefore that would be a totally different story, right? So it is relevant, and one of the reasons why your methodology works well in this based on this data set is that your standard deviations, the variation of the size of the wins and the size of the losses, varies very little. So it produces a very stable outcome. This is one of the reasons. Okay. Now, the other aspect which is very important to analyze, which we also got from Monte Carlo, is what is the worst case drawdown. But notice that worst case scenario is $274, and best case scenario is 155, being the average. Okay. In this case, I'm not looking for the median. I'm trying to be a bit more pessimistic because it's risk. So I'm trying to be a bit more pessimistic. And in this case, I'm looking at 214, which is the average, meaning the midpoint between the worst and the best. Okay. That's the midpoint right in between 274 and 155. So if you wanted to do a little bit of extra math, you could be like, okay, so wait a moment. Let's be pessimistic. For me to get my 3,731, which is the worst case scenario of profits, and I'm going to use the worst case scenario of drawdown. So it looks like I have an overall, 14-1 case, meaning that I could be profiting. This is not 14-1 reward to risk ratio. This does not represent that. Okay, please make sure that we are not getting confused here. This represents, in the worst case scenario, how much money could you be losing in order to make your profit. And in this case, it looks like you could be profiting 14 times more at times after 112 trades. You could find yourself profiting 14 times more than the worst case scenario you got to see in your account. So let's say you start day one and you get your worst case drawdown, which is 265. So next thing you know, you keep trading, and after 112 trades, you should have seen your account grow by 14 times more than that worst case scenario. Okay, which is nice. It's not the reward to risk ratio per trade, but it's the reward to risk ratio overall after 112 trades by looking at the drawdown compared versus the profits. Okay, and you can see that those values keep moving slightly as I keep refreshing stuff on my computer. So those 1,000 calculations on the right keep refreshing, and therefore those stats vary by a little bit. But notice that the variation of those stats is very little because I am already randomizing 1,000 samples, which is a lot of randomizing. So when you get statistics of so many samples, those stats tend to remain quite stable. I mean, you could add more rows if you'd like, but your spreadsheet, depending on your computer, your spreadsheet may end up being very slow. Okay, so in my mind, 1,000 is enough. So anyway, two things before we conclude the session today. Number one, we are now extracting conclusions out of this backtested data by randomizing it, creating this Monte Carlo simulation, which is a way, again, I'm really simplifying what Monte Carlo simulation means, but it's a way to kind of try to create new futures that may or may not happen, which are similar but different than the past, and getting stats out of that. And in this case, your backtest was profitable. Your Monte Carlo simulation show that profitability is still showing, and therefore this to a trader should give the trader a great level of confidence of you got something legit in your hands that if you trade it is likely going to produce something which is nice. But again, you don't base this conclusion out of the past data only. That's the key. You are creating new worst case scenarios. Just for fun, I'm just going to play with the figures here. So let's say your methodology, even though this is calculated, right? But let's say your methodology had cases where the standard deviation for losses was 56. Okay? So in this case, notice how the worst case scenarios could be totally different. Okay? Could be totally different. So the characteristic of your backtest will determine, what is likely going to happen in the future. But what's going to happen in the future will resemble the past the most if your standard deviation values are ideally zero or the closest to zero as possible. If those values are great, meaning if I use 400, so now notice that your worst case scenario would be to lose 2,800, and you have cases now where you lose 3,000. So 97% of your methodologies, 97% of the outcome of running 112 trades, it's profitable, but there is 3% of the cases where you will lose up to 3,000. So again, this has a lot to do with, those standard deviation values. In other words, how disciplined and diligent, how stable your results are when you are trading. In this case, when you are backtesting, which I assume that whatever you backtest is what you trade with the same level of discipline in the future. So, and you can also see here from a statistical point of view, the importance of discipline, where if you go crazy with trading psychology and you don't respect your rules, you don't get your stops executed when it's time to execute the stops, then you are hurting those values, and that will hurt the overall performance of the trade, moving into potentially a negative territory where now you can take losses, where if not, in theory, after 112 trades, you would always, 100% of the cases, in this case, would end up in profit. So it's very important to understand, the impact of those variables moving up and down, because this would help you to tweak your methodology. So let's say your methodology had a standard deviation value here, which is too great. Maybe you want to have a rule that where your stops are a little nearer, or maybe you have a way on how, maybe you add a time stop. So if, instead of getting larger losses, if the market is not moving in your favor soon enough, then the time stop will get you out for smaller losses. And therefore that value never becomes too big, where then implies a greater level of stability in the future for your methodology. You would see that when you run the Monte Carlo simulation. Okay, Jeff, how do you run the formula? So again, this would be a Microsoft Excel session, right? If I do explain the formula, so I will not, if you don't mind. But if you do, I mean, I will obviously email you the spreadsheet, and if you do look at the cell, so here's the formula. So I invite you to then, just Google this formula on Excel, this function norm.inv, as well as the random function here. And you can read more about that on the internet, and you will understand exactly what that cell is doing, which I had explained with words, and the formula does the job. Anyway, so now, having said all of that, again, I need full confirmation from everybody that you have understood what I have done in the session so far, and you understand the importance and the meaning of doing a Monte Carlo simulation and why I did it, and why is it important, and the conclusion I extracted from this table, and all of this is understood. I need that confirmation, because now what I want to talk about for a couple of minutes before we conclude the session today is why I'm a little bit skeptical about this data set, and what are certain things that you need to take into consideration to make sure you have it in as data, so when you run all this process, that what I'm about to mention is part of it. Because believe me, it will impact the results. These results look very, very good, and if you do what I'm about to say, probably they won't look as good. They will potentially look good, still good, tradable, I would say, probably, but definitely, risking, less than $300 to make $4,000, that looks extremely powerful. Okay, and in most of the cases, trading methodologies don't produce such beautiful, theoretical, amazing returns. So I want to add a little bit of reality here. I'm not saying that what we did on the right is not reality, but it's processing stats, which we are getting as close as we can to reality in a future. But what's on the left, which is the backtest, is not reality either. That's the problem. Because when you backtest, you look at the data on the chart and you input data on the spreadsheet, and that's not exactly real either, right? So I want to be a bit more pessimistic on taking data and putting the data on the spreadsheet, so then the statistics you get on the right are closer to reality as well, because you've been pessimistic on the left. So then your stats are going to be a bit more on your side, okay? Mark, how could one record double calendars and random conduct trades in Monte Carlo simulation? Yeah, same thing. You would just, you don't need to log, every single row. I bought this call, this expression date, this put, this expression date. I roll, column. That would be painful. What you want to do is something like that. So, I did this trade that day, and this trade produced that profit. I did that trade that other day, and that trade produced that other profit. I trade that day, and that trade produced another loss. You don't need the detail of what you have done in the trade. What you need is that column. That's what you need. So you can just keep it as simple as date, result, and the spreadsheet will do the rest. You can keep it as simple as that. Of course, it's nice to have a bit more detail, but when you do Monte Carlo, you are not creating a spreadsheet with the intention of then analyzing the columns to come up with rules for trade management. That's not what you're doing. You're just logging in the performance of your methodology so you can extrapolate what the future would be in a more realistic scenario, because you randomize stuff. Okay, that's what you're doing. So you can go as simple as that. 2 columns, date, result, Monte Carlo on the right. That's it. Okay, so everyone, and Jeff, listen carefully. So something that is missing here, and I know we talked about it the other day, okay? So I'm not saying that what you have done is not correct. What you have done, to be honest, is, and I told you at the beginning, is a great job. I'm proud, if I can say. You should be proud, and congratulations, because it's the product of hard work, okay? So way to go, 100%. But let's take it to the next level. Phase two, you need to add a column with commissions. Okay. With certain products, it is not relevant because for certain products that we trade, commissions are so cheap. I mean, you go to an extreme. If you trade stocks, depending on your broker, commissions may even be free, right? So it may not be relevant. But in this case, it is very relevant because you are trading a micro contract, and most brokers are going to really charge pretty hefty commissions. I mean, proportionally speaking, the commissions to trade micro contracts are way more expensive than trading mini contracts instead of micro contracts. So again, it will create an impact. It will hurt the results in a pretty significant way. You want to evaluate that. You don't want to leave it out of the simulation. So add a column with the commissions and do that there. Then make sure you review the whole thing. Okay, I see places where, and this could happen. I see places like that. I see places where you have positive, where you have negative. I saw places with 70, 73. This happens to all of us, my friends. Okay, when we log things, it's manual. So everybody has a fat finger here and there, okay? Some rows are probably coming from a different place. So again, make sure your data is impeccable. Okay, impeccable. That's critical. And then the third one, it's count on slippage. Count on slippage. If your targets are limit orders, then there is not slippage there. If your entry is a limit order, there is no slippage there. But your stops are stop market orders, so there is slippage for sure. When you trade a very liquid product, a typical rule you could use is to add one tick of slippage. Micro crude oil futures, it's okay to trade. It's not like it's not liquid, but maybe if you get stopped out at 2 a.m., may not be liquid. So I would say add 2 ticks of slippage. In other words, instead of you get stopped out and you got 70, just add 72. So in other words, instead of losing $70, lose 72. You know what I mean? And for your target, same story, right? When you reach a final target all the way and it's a limit order, I guess this is one of the cases or that case. So if you reach a final target and it's a limit order, so then leave the value the way it is. But if you cut the profit short, okay, and that's because you decided to interrupt the trade or something like that, some trading rule, whatever, and you cut the trade manually using a market order, add slippage. In other words, instead of you made 90, so let's pretend you made 88, and that means that you didn't make $90, you made $88. So again, hurt what you backtest. Anything that can hurt it. Slippage, commissions, the trades that you missed because you were not awake. Get rid of those rows. Anything you could think of. A day that maybe there was a circuit broker. A day that maybe there was a very relevant news. You were concerned the market was going to be volatile. You didn't trade, even though it was trading hours that maybe you would have traded, but that day you didn't because you decided not to. Whatever you can think of. Hurt as much as you can whatever you input in the backtest. Therefore, your stats will end up being more realistic as well because you are being realistic on the inputs of the backtest. Again, for example, not having the commissions, for example, is not realistic, right? So make sure you make it not only realistic, you make it realistic in the pessimist side. That way you are working towards the direction of, it's like training with weights. So you are working towards the direction of making it difficult for this to pass. Therefore, if this passes and you get Monte Carlo results that look very positive, very beautiful, like what we have on the screen, and all the inputs were very pessimistic, so this will give you an ever greater level of confidence to trade it, and definitely, potentially speaking, will give you a greater probability to reach positive results out of this. Okay. Anyway, so my friends, this is all I got for you. I think it's the first time that we spent a whole hour looking at a spreadsheet. We never even looked at a chart. So new experience for us, I guess, but certainly this is something that it's important. and maybe we should have talked about this before. So thank you, Jeff, for sharing the data with us. Thank you, Jeff, for bringing the idea to us, and thank you all for joining me today. No need to say, if you want a copy of the spreadsheet, more than happy to share, and just email me, and I will send it your way. In case you don't have my email, let me write it down on the screen. I'm pretty positive you do, but just in case. So you type Jose at predictive.com, and I will be super happy to send that spreadsheet your way, so you can then customize the columns on the left, input your trading results, and do Monte Carlo simulations. So get a better understanding of what your methodology can do in a best and worst case scenario and the median into the future, and find out if there are future cases where statistics suggest you're going to lose. Even though your backtest made money, you may lose in the future. And that's very important to know, because it happens all the time that traders do a backtest, it looks good, you start trading, then you lose money and you wonder why. And it's because maybe there is too much variability, that standard deviation value is too much, and then the future doesn't look like the past at all. So it's important that you do that, okay? Anyway, so cool. Jeff, good? Yes, I will be emailing you, Jeff, and everyone else. And if you're watching this recorded, just email me and I will be happy to send you the spreadsheet. I do not have a commission column on the spreadsheet, Mark, but I'm pretty positive you can do that yourself, isn't it? You just add a commission column. You just be like, okay, so this is my commission, okay, and I paid $1.20. So, okay, so there are rules in these columns. Let me remove the rules. So you have, not here, preview data. You have data validation, erase, any value. Okay, great. So you have a commission. So let's say you pay $1.20 for this trade. So your result would be this, okay, minus this. So your net result is 258. I mean, if you add decimal places, which you don't need to, but if you add decimal places, so your net result is $257.80. So you could add the column yourself, and again, as long as you reflect on the results column what is the net result of whatever you are logging. So then everything on the right, you don't need to touch it, and it will do your Monte Carlo simulation on the right. If you touch what's on the right, let me tell you, you're gonna mess it up, because especially those 1,000 columns are very complex to put together. So I mean, I'm not saying that you could not do it, but it's not the classical Excel formulas here in these 1,000 columns. It uses a different format. We use a function here called where was it? The what if analysis. So it's a bit complex. So in order to do that, I recommend you to not to touch it, or even I would even say save 2 copies of the spreadsheet. So if for whatever reason you end up messing up the formulas and you don't know what to do next, you have a backup copy of the spreadsheet somewhere on your hard drive, so you can recover it and again do it again. So work using the columns from the left, and ideally you don't touch the columns on the right, because they are quite sensitive. Anyway, my friends, a pleasure as always. I'm very happy that we covered these materials today, because this obviously is powerful, relevant stuff. So hopefully this can help you. Let me know when you use it for yourself, for your own sample data, and how did it help you, or how did it not help you. And again, happy to conduct a future session on this topic if you need to. So just let me know. Take care, everyone. See you soon. Trade well. Bye-bye.